Hi, my name is Mike Conley of Landlord Real Estate here in Fremont, and all we do is help landlords like yourself sell their rental homes at the absolute maximum price. And what we're going to do in this short video is just go over the basics of what's called a 1031 exchange. And to do that, we want to start with what your capital gain is going to be when you sell your home. Your capital gain basically is what you sell the property for, less your selling costs. That is the real estate commissions and your closing costs. So whatever that number is, we want to subtract from it what you paid for the property originally, plus your improvements. So whatever that number comes out to is what's called your capital gain. And guess what? You're going to be taxed on that capital gain significantly. To the feds, you're going to pay about 15%. To the state, about 10%, Medicare, about 4%, and you're going to pay a tax on 25% of the depreciation that you took while you own the rental property. You add all those up, and it's approximately 33%. That is the capital gains tax that you're going to pay on the profit of your sale. There is no way you want to pay that kind of tax, and that's why it's so fortunate that we have this allowance in the tax code called the 1031 exchange. Because if you purchase another rental property or properties within 180 days of the close of escrow from the one that you're selling, and it's of the same or greater value, you pay no tax. That is the 1031, bottom line. Here are the reasons you want to perform the 1031 exchange. As we mentioned, you're going to defer the capital gains tax. How long do you want to defer it? Until you pass away. Because when you pass away, your heirs, whoever you leave the property to, they can then sell the property right after your passing with no capital gains tax. Because the value of the property upon your passing is stepped up to fair market value. And that's why the 1031 is often referred to as swap until you drop. The second reason is that you're going to get a better cap rate if you do a 1031. So let's say you sell your rental home here in the East Bay, and it has about a 2.5% cap rate. Your cap rate is determined by taking your net operating income for the year and dividing it by the purchase price of the property. That gives you your cap rate, and typical cap rates for homes in the East Bay are 2.5% to 3%. But let's say you take the proceeds from your sale and you go to a place like Sacramento and buy 2 duplexes for the same amount of money. Or you go to Fresno and buy a 6-unit apartment building for the same amount of money. You're going to get a greater cap rate. A third reason is because maybe partners are not seeing eye to eye on a property. You've got siblings with different goals. You sell the property, each can do their own thing, a 1031 or not. Number 4, you might have a problem property, issues with the foundation or management problems, or it's in a bad part of town. You want to just get rid of the problem, take the proceeds, buy another rental property. And then finally, the 1031 is the way to expand your portfolio. This is how investors go from maybe starting with a rental condo to a duplex, to a 5-unit apartment building, to 2 retail buildings. This is how you expand your portfolio throughout your lifetime. So all reasons to perform a 1031. Here's some rules to keep in mind. Number 1, it can be any type of rental property. So let's say you sell a rental home and you want to do a 1031. You can buy a couple of duplexes. You can buy a retail building or an office building or a warehouse or a piece of land. Any income producing property can qualify as a 1031 exchange. It doesn't have to be identical to the one you're selling. Number 2, the property must be in the USA. Number 3, you have to identify the replacement property within 45 days. And that, friends, is a blink of an eye, and we'll get to that in just a moment. Number 4, you must use what's called an intermediary. In other words, when you sell your current property now, you cannot touch the proceeds. At the close of escrow, the money goes into a a third party called an intermediary's account, and they hold the money for you until you're ready to purchase your replacement properties. Number 5, you only have 180 days to close escrow on the replacement property or properties from the time that the escrow closes on the property that you're selling now. And finally, you can purchase multiple replacement properties. It doesn't have to be one for one. So if you're selling a property now, you can take the proceeds and buy 2 or 3 replacement properties. So those are some of the basic rules for the 1031. And here's why Landlord Realty is the ideal agency to consider. Number 1, we've done them personally. Both my brother Tom and I are brokers that have done the 1031 for our own properties over a dozen times. So we don't have just a vague understanding of the 1031 process like most realtors. We know all the idiosyncrasies, and we know the ins and outs of the transaction. And then second of all, we have the powerful tools to help identify the replacement property or properties, because you only have 45 days from the close of escrow. And what we have is a database called CoStar. CoStar basically allows us to look at any property in California that's a rental, whether it be an apartment building, a office building, retail building, warehouse. And so it's very expensive to subscribe to. We're the only residential realtors I'm aware of in the East Bay that has a CoStar subscription. It's almost always reserved for commercial realtors, but we have it. And we're able to, with your goals in mind, identify the properties that make sense and make offers on them. So this is the 1031 process. Just one more reason to do business with Landlord Realty. If you have any questions at all, please call my brother Tom. He's the broker here at 510-656-7653. Good luck and thanks for watching.